Hi traders, and welcome to the next video in this course. In the last video we took a look at central banks and monetary policy, and we discussed how everything in trading and fundamental analysis revolves around the central bank. And then in monetary policy we talked about how the central bank will use interest rates to control money supply, and how anything really taking place in monetary policy is to control money supply, and the reason for that is they want to achieve their mandate and their objectives, which are normally tied down to the inflation rate in the economy. Now, when it comes to interest rates, there's two main things that the central banks will do. One, they can just set the interest rate where they want, wherever they feel it's most appropriate. Of course, they've got to do this in a bit of a structured manner. They can't just keep throwing out random interest rates at every meeting. It's got to be done in a bit of a structured manner, except for extreme circumstances where they can make much bigger changes. So, for example, the pandemic, that was a major shock to the economy in 2020. The global economy had essentially been shut down. So central banks around the world at that time, wherever their rates were, they could have been at 3%, 2%, maybe even higher. They took those rates and dropped them down to 0 or somewhere around 0. Normally though, in the developed countries and their central banks, they will usually use increments of 25 basis points, which is equivalent to 0.25%. That's the way that they will move. So if they want to increase rates, they'll normally do 0.25%, and the same for if they want to cut rates. Again, though, under more extreme circumstances, if they want to go for bigger moves, they can. But they wouldn't do that on a regular basis, because otherwise it would create a lot of uncertainty for the markets and the economy. So that is one way that the central bank will control the interest rates. They simply set the interest rate wherever they feel it's most appropriate. Now, we also talked about how that interest rate set will basically impact what the member banks do with a lot of their credit products. But if for some reason the central bank feels like the market and those banks are not really moving towards the rate that they've set, then another tool that the central bank uses quite a lot is open market operations. And we looked at the yield curve, and we said that the central bank will typically focus on the short end of the yield curve, so the left-hand side of the yield curve. And the way they do this is the central bank has control over the printing of money and the destruction of money. So if they feel like they need to make some adjustments and basically set the rates in the bond markets, usually with government bonds, they can print some money and buy bonds with short-term durations. These could be 1 month, 3 months, 6 months, a year, generally no longer than a year. So they'll buy them, or if they're holding them, they will go and sell them to try and move the yields, and that's another way they can control the interest rates in the markets and basically make sure that the interest rate that they're setting is feeding through into the markets so that it has the desired effect. Now, in this video, what we're going to look at is a bit of an extension of open market operations. That is a primary tool that has been used for years by central banks. But the tool that we're going to look at here, quantitative easing, that is something that is relatively new, but it has been used extensively over the past 12 to 15 years. And it's very important to understand how quantitative easing works and why central banks use it. So let's get into the video and understand what quantitative easing, or QE, is. So QE is an unconventional policy tool. As I said, it's something that's been used more in the last 12 to 15 years. Before that, it was all about interest rates and open market operations. They used to work very well. But sometimes you can find yourself in a situation where you've exhausted everything you've got. Remember, with rates, you can take them down to zero and you can take them into negative territory. But there's only so much that you can take them into negative territory before those rates stop really having an impact on the markets. And then you're just stuck with the negative rates, which can actually have other negative consequences in the economy. So you're limited in how much downside you can go with rates. Now, on the upside, technically, in theory, it's unlimited. But again, if you go too high, there will be unwanted consequences, and there could be unwanted surprises in the market. So you want to stay in a sort of reasonable range when it comes to interest rates. But like I said, sometimes you do everything you can and it's simply not doing enough, or it's just not working. So back in 2008, when we had the global financial crisis, central banks at that time, they lowered their rates to 0%. They needed to stimulate and liquidate the economy to try and get it to recover. They lowered the rates to 0% or around 0%, and that was not enough because of how bad that crisis was. The financial sector was on the verge of collapsing. Something that we'd literally never seen in the past. Most investment banks will never ever fail, or that's what was thought up until 2008, because of how much money they have and how powerful they are. But in 2008, we saw a couple of major mortgage companies and investment banks collapse, and that had an impact on other banks as well. So we had a major financial crisis, and central banks, they lowered their rates to 0%, but it just wasn't enough. So they then brought out this new tool, which is called quantitative easing. Now, quantitative easing is very similar to open market operations. The central bank prints money and they buy securities, just like they do with open market operations. The main difference here is, with open market operations, you tend to focus on the 1 year and below range in terms of the durations. Very short-term durations is what the central bank will look at. With QE, you're looking further out. You'll be looking at 2 years, 5 years, maybe even 10 years. Now, with open market operations, because that's focused on the short end of the yield curve, what the central bank is typically hoping is when they make adjustments to the short end, it will start to have a bit of an impact on the longer end, which it normally does. But once again, sometimes you can do as much as you possibly can with certain tools, and it's just not having the desired effect. So what happened in 2008 is they brought the rates down to zero, but there was only so much they could really do with the short end of the yield curve, and it wasn't doing enough to the long end of the yield curve to help the economy recover. So that's where central banks had to bring out QE. And the securities that we're talking about here, they are bonds. And within QE, they are typically bonds, normally government bonds. In 2008, there was a lot of MBS products, which is mortgage-backed securities. So these are still bonds, but rather than you giving a loan to the government, which is a treasury bond or just a government bond, with an MBS, the bond contained several mortgages. And given that we had a housing crisis in 2008, it was best to print that money and spend it on MBS products to support the housing market, which then supported everything else in the financial sector, and that then supported the rest of the economy. So within QE, you can really go and buy any type of security that you want. In Japan, we've actually seen them buying ETFs, which track the Japanese stock market. So that's also a possibility, but typically it's going to be government bonds and mortgage-backed securities. So fixed income products. And as we've already gone through, that impacts the longer end of the yield curve. And when you're doing QE, what you're trying to do to the longer end of the yield curve is bring the yields down. You're trying to lower the rates because it means that borrowing for a longer period of time is then cheaper. And if borrowing is cheaper for a longer period of time, companies are more likely to spend large amounts on big projects and take out loans and take out credit. And that helps to then stimulate the economy. Imagine if the rates on the short end were, let's say, 0%, but on the long end, so we're saying maybe five years onwards, they're about 5%. So you don't mind taking a loan out for maybe 2 years, 3 years because the interest rate is very low. But beyond that, you've got to think whether you're going to be able to make the interest rate payments. There's more uncertainty the longer out you go because a lot can change in 5 years, 10 years, 15 years. But if the longer end, so if from 5 years onwards, if those rates came down to, let's say, 2%, well, now you're thinking that, you know what, 2% is doable. It's not that much money that I've got to pay in interest. That's fairly comfortable. And now businesses and even governments, they're thinking, we can take out big loans and spend them on extensive projects, which will take 5 to 10 years to complete. But it could boost our revenue massively. And it could help the economy a lot if it's government spending. So that's the reason why central banks used QE, and that's the reason why they still have QE as part of their toolkit. But with all of that being said, there are some issues with QE. So let's move on to the next slide and learn about what some of the disadvantages are. The first major one, which we have seen, is it can cause asset price bubbles. Now, with QE, the central bank, as we know, is printing a lot of money and they are buying certain securities with longer term maturities. The way they buy these securities is they'll go to a asset management firm. Where are they going to buy these government or even corporate bonds from? They're going to go to maybe a pension fund or a hedge fund or some sort of investment management firm, sometimes even to the investment banks. And they'll say, we're going to give you X amount of money. It could be, let's say, $10 million. We want to buy these securities from you. So the firm will take that money from the central bank. Now, because it's a longer term duration, you know that you don't need to give that money back to the central bank, or the central bank's not going to try and redeem it for 5, 10, 15 years, whatever the maturity is on those products. And if you are a pension fund, a hedge fund, an investment bank, whatever you may be, do you really want to just sit on $10 million? Do you want to just keep that there? You're going to have inflation in the economy, which means that if the money's just sitting there, it's actually losing value. And also, you're missing out on opportunities. So what these firms will actually do, because they've got that 5 to 10 year cushion, they'll be thinking, you know what, let's go and just invest it. Whether that's in the business, whether that's in equities, putting it into another asset class, they'll go and invest that money. And what they're trying to do is the central bank has bought they've bought the bonds from them. Now, there's going to be interest rate payments that have to be made on the bonds. So what the bank or what the pension fund or what the hedge fund is going to try and do is they want to put that 10 million somewhere where the return they get on that is more than the interest that's being paid on those bonds which they've just sold to the central bank. So you're going to look at something like corporate bonds, which typically pay more than a government bond, or equities. That's riskier, but they have higher returns on average compared to bonds. Or, as I said, you might just invest it somewhere into the business into some sort of expansion, and you're hoping that that's going to provide a substantial increase in revenue. And again, you're looking for a better return there than you would have gotten with the bonds you've just given to the central bank. But by doing this, especially when these institutions decide to put the money into something like equities, if you have a lot of institutions doing that, then there's a high demand for equity, so it starts to push the price higher. But then when you get to the point where the central bank wants to take out this liquidity because they're saying, okay, it's done its job now, we don't still need all of this money supply there, we need to reduce the money supply. And when they start to get the money back, when those bonds start to mature and the bank they've bought it from needs to give the central bank their money back, where are they going to give that from? They've got to liquidate whatever they've put the money in. So if they put into equities, they need to sell some of their equity holdings and give that money to the central bank. If they've invested it into their own business, they need to hope that their business has generated enough revenue to pay the bank back. So one of the problems with QE is it can cause those asset price bubbles, and then when you get the reversal of QE, which is quantitative tightening, or QT, that can cause a lot of volatility and panic in the markets, because all of a sudden a lot of liquidity is being taken away. And because of that, the withdrawal of the liquidity can be quite complicated. The central banks, when they decide, okay, the markets are fine now, we can reduce the amount of QE, we can start to take this money out, it's not as simple as when they put the money in. When they put it in, they just printed loads and loads of money and bought all of these securities. But when it comes to taking it back, they've got to be much more careful, because it can create a lot of volatility. It can create a lot of fear in the markets, and they need to be careful they don't cause a financial crisis, or they don't cause equities or whatever assets we're looking at to move down too much, because that could then lead to a financial crisis. Remember, there's going to be a lot of retail traders or retail investors in the markets, so they could lose a lot of money if there was too much downside in the market. So it's a very complicated process to remove that money. Another issue you have with QE is it's still a relatively new tool. It's only been really used extensively since 2008. The problem with that is, because we are looking at the long end of the yield curve, we are still learning a lot about QE. We don't know everything about QE yet. There are still some unknowns. So even though it is still used by central banks, there is that risk, there is that uncertainty risk, just that element of not fully knowing what impact QE is going to have. And the final issue you have with QE is, because you're targeting the long end of the yield curve, it means that it can cause longer lasting effects on the economy. Like we said, the withdrawal of the liquidity can be quite complicated, and you don't know what effect all of that stimulus is going to have a few years down the line. In the initial stages, it's going to create some inflation, which is a good thing, because you're trying to get the economy to recover. But after that, if it continues to cause inflation, inflation could get out of hand. And that's where, again, you've got a major unknown, because you don't know how quickly the economy will recover, how quickly will demand come back, what's going to be happening with other economies around the world. There's many unknowns there, and as we've been saying, the longer the time frame that you have, the more uncertainty, because the more that can happen over that time frame that could disrupt your projections and your forecasts. So those are the issues you have with QE, but in extreme circumstances, we have seen that, at least in the initial stages of an economic recovery, it is a very useful tool. Now, after going through this, some of you may be asking, why do they then use quantitative easing? So the first reason, as I said, is it has been proven to work, at least in the initial stages. The withdrawal is still a big issue that central banks, I think, need to figure out over time. And one of the other issues with this, because they've got to be so careful with how they withdraw the liquidity and how quickly they do it, is whilst they are withdrawing the liquidity, what if you have another economic downturn 3 or 4 years down the line? Then before you've even withdrawn all of that liquidity, you might find yourself in a position where you've got to do some more QE and increase the liquidity further. And if you stay in that sort of repetitive cycle, then it just means that the balance sheet, so the amount that banks are buying and the amount of assets they're purchasing, the total amount is just getting bigger and bigger overall. So that can be a bit of an issue as well. But initially, it can be a good tool to use and it can provide a boost to the economy. And the second reason why central banks have something like QE is it's simply another tool that they have available to them. And the example that is worth thinking of is flying a plane. Think about when a plane is landing. Now they need to slow down to a speed where they can actually land and hit the tarmac. Now the obvious way to do it is lower the thrust and use the speed brakes. But they've also got things like the flaps, and they can lower the gear, which creates extra drag to slow the plane down even further. So if you're flying a plane, you're going to be using all of these tools that you have available to you. And similarly, a central bank is going to use all the tools they have available to them to boost the economy when it's required. But these issues with QE, they are worth keeping in mind because they can create risks later down the line when you're going through an economic expansion. So that's quantitative easing, and that brings us to the end of this video. Thank you for watching, and see you in the next video.